The momentum does seem like it's peaked, and starting with the U.S., there's no costless way of reducing inflation. What I think we'll see in the weeks and months ahead is a significant tightening of financial conditions, brought on by more stringent lending standards, with the local and regional banks still struggling to ensure funding beyond the 12-month discount windows or the BTFP, the Bank Term Funding Program, and so on. The whole funding structure needs to adjust to a regime of higher rates. And that will slow down activity. It'll slow down lending to the commercial real estate side, to even residential mortgages and so on.
That is so critical, Aninda. I just want to interrupt you and ask you, where are we on that adjustment?
So we are, the high-frequency indicators do show a tightening of lending standards. The PMIs, the ISM numbers, are below 50 on the manufacturing side, but services are still looking strong. But it does feel like the business cycle is beginning to peak and keel over at some point. And so I think it's quite telling that it's the central banks around Asia, at least, are seeing a significant slowdown led by exports and manufacturing. So the MAS hold decision from late last week underscored that point. So I think we're turning much more cautious. Our central view right now is that a sequential slowdown in the U.S. is pretty much unavoidable. We have more than an even chance of that materializing. In the event it's delayed, we'll see an even harder landing next year.
Does it feel then that policymakers, one by one, are starting to jump on the pause bandwagon? And is that the Fed's most prudent course of action come May the 3rd? And is this going to be a conditional pause? And how long do you think it will last for before they start resuming the tightening?
Yeah. So look, it's a close call. We are actually looking at a hike at the May meeting on May 3rd.
Yes.
Admittedly, it's a close call. If there's a lack of unanimity or let alone a consensus on the FOMC board, then the appropriate thing to do perhaps would be to opt for a hold. However, the minutes did show that there was a sense of satisfaction that they were taking care of the regional banking sector risks, and they did go with the dot plots, with the median dot plot suggested a 5.1% rate. So I think they'll go ahead with that hike for now and then opt for a hold. But again, we're quibbling about 25 basis points here and there. The bigger point really is the Fed has a much more narrower path towards maintaining financial stability risks from spilling over to slowing the economy on the one side. We're not expecting a financial crisis by any stretch, but the inflation numbers are still very, very sticky on the core side. If you look at rents and shelter, inflation, or healthcare and wage growth, those are still inconsistent with bringing down core inflation as quickly as the Fed would like to see.